Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
You know, governments hand out billions of dollars to businesses every single year. We're talking huge subsidies for factories, grants for cutting-edge research, you name it. But here's the crazy part. Figuring out how a company should actually account for that free money, well, for the longest time, it's been a complete mess. Now, a new rulebook is here, and it's supposed to change everything. So let's decode what's really going on.
All right, so the official referees for business accounting in the U.S. are the Financial Accounting Standards Board, FASB. And in December 2025, they dropped this, a brand new standard that's meant to finally bring some clarity to how companies have to report all those government grants they're getting.
I mean, it seems like such a simple question, doesn't it? A company gets $10 million bucks, where do they put it? But believe it or not, for decades, the answer for any U.S. company was basically, it depends. You could have two companies get the exact same grant, but an investor looking at their books would see it reported in totally different ways. It made comparing them, well, almost impossible. So before you can really get the solution, you have to understand the problem. And when it came to government grants, it was a big one that had been around for a very long time. No, you heard that right. For more than half a century, as government support for business was just exploding, the official accounting rulebook had this giant gaping hole right where the rules for these grants were supposed to be. Just nothing. And in that vacuum, it was basically the Wild West. Companies had to choose their own adventure. Some tried to copy international rules, others grabbed rules meant for nonprofits, and some just kind of picked and chose bits and pieces that they liked. The result? A total free-for-all. It was like watching a game where every team was keeping score in a completely different way. You had no idea who was actually winning. So to finally bring some order to all of this chaos, FASB stepped in and issued a new official standard, Accounting Standards Update 2025-10. This was supposed to be the answer. Okay, first things first, they had to define what they were even talking about. So a government grant is a transfer of assets, things like cash, a building, maybe some equipment. But the key phrase here is other than in an exchange transaction. This isn't about a company selling widgets to the government. This is about receiving support basically for free. The new rule also sets up this really clear two-part test for when a company can actually record the grant. And the magic word, the one you got to remember, is probable. It has to be probable that the company will meet all the strings attached, and it has to be probable that they'll actually get the money. Both have to be likely. So the standard pretty much splits grants into two main buckets. Some are just to cover day-to-day expenses, but the really interesting part, the part that's causing all the debate, has to do with grants for assets. So money a company gets to help buy something big, like a new factory. And right here, companies get a huge choice. And this choice for asset grants is one of the most important parts of the entire new standard. And as we're about to see, it's exactly where the big fight begins. The slide just lays out the two options perfectly. So imagine the government gives you a $50,000 voucher for a brand new delivery truck. With the deferred income approach, you put the truck on your books at its full price, and you slowly recognize that 50 grand as income over the truck's life. Simple enough. But with the cost accumulation approach, you basically just say the truck cost you less to begin with. You just net it out. And under the new rule, both are totally fine. Now, you'd probably think that a new rule designed to create clarity would get a round of applause, right? Well, here's the twist in the story. It absolutely did not. The final vote to approve it was deeply, deeply divided. 3 members of the 7-person board formally dissented. And let me tell you, at FASB, that is a huge deal. It's not just a minor disagreement. It signals a fundamental clash over the entire philosophy behind this new standard. So, what was their beef? Well, their number one criticism was that FASB didn't really create a new, better standard from scratch. They argued it just copied an old, flawed international standard, IAS 20, warts and all, and basically cemented it into U.S. rules. And they didn't stop there. They said the rule actually violates FASB's own core principles, its constitution, if you will, and maybe even more important, that it completely ignored what investors, the very people these reports are for, were asking for. And what's so wild is when you lay it out like this, you can really see the disconnect. Investors said, hey, we want gross presentation. We want to see the full value of the asset and the grant separately. But the rule allows net presentation, which can hide the grant completely. Investors ask for assets to be valued at what they're actually worth, But the rule lets companies record an asset at zero if the grant covers the whole cost. And the biggest one, investors begged for fewer options to make companies easier to compare. And what did the new rule do? It officially put two completely different options into the rule book.
And this has some really serious consequences. Just think about that cost accumulation approach for a second. If a company gets a $100 million factory for free and records it on the books at a cost of zero, well, any profit it makes from that factory gives it an infinitely high return on assets. That key performance metric just becomes totally inflated, and, you could argue, pretty misleading.
So after all this debate, all this controversy, what does this actually mean for companies, for auditors, and especially for investors?
Okay, so when does this all kick in? Well, the rules don't become mandatory for a few years yet. 2028 for public companies, 2029 for everybody else. But here is the catch. Companies are allowed to adopt them early, right now, which means you could start seeing this new accounting show up in financial statements, well, any day.
So let's just boil this all down. On the one hand, yes, we finally have a single official rule in the US for government grants, which should, in theory, tame some of that Wild West chaos. But on the other hand, that same rule bakes in major options that make it harder to compare companies. And you've got this really powerful dissent from inside FASB itself, arguing that this was a huge missed opportunity to give investors the transparency they were actually asking for.
Which really leaves us with the big question at the end of the day. After waiting 50 years for a clear standard on government grants, did FASB actually deliver clarity? Or did it just create a new, more official brand of confusion? Honestly, that's a debate that investors and accountants are going to be having for a very, very long time.